Okay, let's practice with a bond payable issuance at discount. This practice is comprised of transaction analysis, discount bond schedule, and then journal entry, linking with the journal entry outcomes to the balance sheet, the year 2013 and income statement, to the balance sheet 2014 and income statement, and the final year. So this transaction incurred the January 1st, 2013, and the company issues a discount bond that states the following certificates. The maturity is 3 years, 3-year bond. Let's make it just as simple. That usually the bond has like 20 years or 30 years, a little longer time. But in order to make this simple, we have just 3 years, just by assumption. And the principal is $100,000. This principal is the same concept as the face value or the par value or bond payable in thousand. And then coupon rate of this bond has 8%, which is state rate. That means that the company will pay $100,000 face value principal times 8%, so $8,000 for three years every year as a coupon amount. And the market rate is 10%, and then bond price is $95,000. So what does that mean? The bond issuer issued the bond with the coupon rate 8%. They think the risk or compensation of this bond is just 8%. This is appropriate rate. But the market perspective is different. Market required at least 10% to invest in this bond. But the issuers already produces this bond with 8%. So how can they negotiate and then make the bond issues happen? Right. The bond price $95,000, which is the discounted price. The investors put their investment amount, $95,000, to buy this bond. Even though the bond value, par value, or face value of this bond is $100,000. But at the end of the maturity in 3 years, the bond investors will receive $100,000. Why? They just receive 8% coupon amount every year. The difference between 10% and 8% should be given to investors. So the difference between $100,000 and $95,000 is the bond discount amount, which is a part of the interest, the difference between these two percentages. Okay? So let's make it sure that how this interest expense and coupon payment and discount amortization and the book value recorded on the balance sheet and income statement before journalize this transaction. First, the book value. The book value means the bond price, the actual borrowings for issuers. So $95,000 is the book value when they issued this bond on January 1st. And then December 31st, 1 year later, the company borrowed not $100,000, but $95,000. That is actual borrowing, actual bond price when they issue. So the book value times what rate do we need? That's correct. We need the market rate, because market rate is actual borrowing rate. So interest expense, when do we recognize expense? When it occurs, when the company uses the borrowings. So 95,000 times 10%, so $9,500 is interest expense the company should recognize on the balance sheet, on the income statement. And the coupon amount, that is only the cash amount based on the bond, the nature of the bond. The nature of a bond is the maturity 3 year, the face value 100, and the coupon rate 8%. So the face value 100,000 times 8%. So 8,000 is the coupon payment, which is cash out. But the company should recognize actual interest expense. In this case, the interest expense is greater than the coupon payment. So the discount now should be reduced by this $1,503. Why? Because the coupon payment $8,000 should have been $9,503, but the company only gave the investor $8,000. But at the end of the maturity in 3 years, the company should give the investors $100,000, which is par value, even though company received $95,000 when they issue. So every year, the company will pile up this interest amount every year end by the difference between the interest expense and the coupon payment, which is the discount amortization. And this amount, as I mentioned, will be increased. Got it? The next year, the company also should recognize interest expense, book value, times actual borrowing. Now is 96,525 times market rate. And the coupon payment still the same. Every year, the actual cash payment to the investors is always the coupon amount. But it's not based on actual borrowing times the market rate, just the coupon amount. So the difference between two is 1,653. It should be added to the book value. So now you may see this $95,000 bond price, actual borrowings, now increased. Maybe you can guess what? The final year, when a maturity comes, that book value should be $100,000. Let's verify. 98,000 times market rate one more time, 10%, and the coupon payment, the same amount. The difference between two is the discount amortization should be piled up to the book value. So $100,000. Now that $100,000 is the same as the principal. You got it. So we finished the discount bond schedule when the market rate is greater than coupon rate. Based on this schedule, let's create a journal entry. A 3-year discount bond is issued for the market rate to 10%, so same information as this. Then let's just start from the easy one on the credit side. What account do we need when the company issue a bond? Bond payable. How much? Bond payable is always the principal amount, 100,000. That is the gross amount of bond. The bond price the company received from the investor is 95,026. Then what is the difference between two? That is the amount of discount bond discount. So the difference between two is the discount. We will amortize this amount every year by recognizing interest expense greater than the coupon payment. Got it? So next year, now, not next year, sorry. The 1 year later, at the end of the year 13, December 31st, now the company should recognize interest expense. Why? Because the company used cash borrowing $95,000 for 1 year. So interest expense recognized and discount amortized, the difference between actual cash payment and interest expense recognition. So let's do the easiest one. The credit account cash, how much the company paid cash out? 8,000. And here on the debit side, now the company should recognize interest expense. Interest expense 9503. So the difference between two is now discount amortization. So the discount, bond discount, the same name of account. So by the recording the bond discount on the credit side, so we amortize this bond discount. Bond discount on the debit side means the bond payable is reduced by this bond discount. The bond discount is the contra account that reduces the bond payable and then arriving to the net bond payable. But this bond discount reduced by the bond discount on the credit side, then the net bond payable will be increased by the bond discount amortization. 1 year later, one more time, the cash and the bond discount. How much is the cash out? The same amount, 8,000. And the interest expense, second year, 9653. And the discount amortization, 1,653. And then final year, now one more time. The cash the company received, 8,000. And the bond interest expense, the last year, the company should recognize $98.18. Then the bond discount, the difference between two is $18.18. Then, that's it? No, because we should pay back bond payable $100,000. So it should be added to $100,000 bond payable. Once the company pay back the bond payable, which is the principal amount, $100,000, the company no longer have bond payable. So this amount is $100,000. That's it. Then let's link all the journal entry into the balance sheet and income statement from the year 13 and year 15 for 3 years. Okay, here the cash up by 95, which is actual borrowing amount, and the bond payable increased 100,000. And you have to be aware of this account one more time. The bond discount is contra account that reduces the bond payable that arrives to the bond payable net amount. So it should be negative. That's why you record on the debit side. So this amount, we need, before calculating this. Now this bond payable net when the company issue is 95,026. At the year end, interest expense and cash and bond discount the amortization recognition. Interest expense and cash. Let's do the cash first. Cash down by 8,000 coupon payment. And then interest expense, the bond discount 15,003. Now we should put the plus sign because the bond discount on the credit means that reduce bond discount account. So minus reduce, in order to reduce minus account, we have to put the plus sign. So the bond payable net is 96, which is the same as the bond schedule, the book value on the bond schedule. Okay. So Finally, we should recognize interest expense based on the actual borrowing times the market rate, 9,503. Then the net income should be linked to the retained earning. Let's make sure that if we balance out between the asset and liability and equity. Okay, we match. Good. The balance sheet as of December 31st, 2014. Now we need to record this. But remember that before recording the second year balance sheet, you should always start the ending balance of the prior year of all the balance, cash and the bond payable and the bond discount. Okay, and then retained earnings. Always you have to start because the ending balance of the prior year is the beginning balance of the second year. So it should be cumulated. That's why we record as of December 2014. That means the company record the transaction, all the transaction are from their start of business to now. But the income statement is the 1 year transaction. It should not be linked. The prior year, the income statement should be separately recorded to the next year. Okay? So once we finish up this setup, and then let's link this journal entry to the balance sheet. Cash amount one more time, minus 8,000 on the credit side. And the bond discount, now we want to reduce one more time by putting plus because this is a negative account. Negative account. In order to reduce the negative account, we have to put the plus sign. That's why bond discount on the credit is on the credit. So the bond discount now is 1818. So the bond payable, that the bond payable net amount is 98,000, which is the same as the book value amount on the discounted bond schedule table. Okay, and then we should record the interest expense, 96,653 should be linked to the retained earning. Should be cumulated retained earning. You guys got it? So let's make sure that if we matched out between the total asset and total liability and equity. Perfect. The final year transaction, also we should start from the ending balance of prior year on the balance sheet. The bond payable, always face value based on the historical, the original cost, the principal, and the bond discount. Then the net amount, same as this, and the retained earning you have accumulated. Now let's record interest expense, cash 108,000. Let's do the cash transaction first. Cash out the 8,000, the coupon payment plus the $100,000 principal. So 108,000. The cash amount negative 28,974 throughout these all the bond transaction. And then interest expense. Oh, before jumping into this interest, bond discount. Now bond discount now plus 1818. So, we don't have any bond discount anymore because we have recognized all the interest expense correct way. The difference between two is the discount amortization that shouldn't have been distributed to the investors, but the company didn't because the company will give back the investor $100,000 even the company received $95,000 when the company issued a bond. Okay, the difference between two, which is the discount, the bond discount, is the part of interest, the difference between the interest expense and the coupon payment. You guys got it? And then the interest expense on the last year, so it should be linked, cumulated to the retained earning. Okay, and then the bond payable. Okay, the bond payable, now we don't have any bond discount, but the bond payable should be 0. Why? The company paid back $108,000 at the year end, the maturity. Okay, so total asset and total liability is now matched. Okay, then we finished this exercise. Let's take a look at the bond payable, the changes in the bond payable net and the bond discount. The bond payable doesn't change every year. Every year doesn't change, but the bond discount amount has been reduced, and then the last year of the maturity became 0. And then the bond payable net amount is discount amount, and then it is increased, and now will reach before recognition 100,000, and then when the company paid, nothing. Okay, so that's it. This video clip have covered only the issuance at discount. Next video clip will explain the issuance at premium. See you later. Bye-bye.